What's up, Sloth? Can you see the screen? Can you hear me?
Yes, sir. How are you?
I'm good, and yourself? Just get things set up here. There we go. Just wait for a few more guys to hop on. What's up again? Okay, so we've got all good in yourselves again. All good in yourself. Right, shall we start, Sloth?
Yeah, I'm good.
Okay, cool. And you can see the screen, you can hear everything, everything's good.
Yeah, perfect.
Okay. I think last week you missed the stream last week live. We were at this point here, right? Yeah, I think here. Was it Sunday? Sunday was here, right? We were here. We tapped into let's just have a look here, right? I think it was the weekly open. Yeah, so we came down, we tapped into the weekly open here and just tapped the top of this fair value gap here. Not a complete full, I think it was just a tap of the fair value gap. Let's just tighten that up before we continue. So somewhere there, this was the fair value gap I'm talking about, and you can see we just tapped into it on BTC here. Right, and then price moved away. Now let's look at some hindsight into where we could have possibly entered on this. And for the last 3 weeks I've been telling you about the entry model where you get the accumulation, failure swing, opposing liquidity run, push, retrace, continuation, right? And that would form around fair value gaps in the range. So after we get the break of, let's just have a look here. So this was the low that we needed to break for liquidity to be taken, was there. Let's call that a liquidity grab. And once the liquidity is taken there, the lowest closing down candle is where entries, or where we would look for entries to form. I'm going to darken that up for a bit, make it green, and let's go there, right? So at the green, which is basically the order block before the break or the liquidity run. Now what we need to look for is any signs of fair value gaps which could have formed in here, and I'm not seeing anything on this, on the 15-minute time frame. Let's just go lower, because there would be something down here that would, yeah, here we go, right? So at this point, once we got the opposing liquidity run down into the FEG here, you're looking for fair value gaps that led into the order block and that would be something here, right? So you take that out in time. Now this FVG here, let's just delete that one. This fair value gap here would confirm market structure shift, and we would look for re-entries as price returns into it. So if this was the order block here, this candle, let's just go in a bit deeper here. This candle here confirmed the order block there, right? And this candle here closing above confirmed the market structure shift. So the entry, if you were aggressive, was the very next candle in the sequence would be this one here, and your stops would obviously be set below that. If you if you were looking for alternate entries, then you could have waited for a retrace into a discount level to enter. So that simple stuff from the bottom to the top. Let's look at PA fibs, and then you'd look at optimal trade entries around your fair value gap, anything below the 50%, and we found it here, right, at the OTE and the fair value gap. Now, this piece of price action here is what liquidity engineering is all about. Once you start to see PA that forms like this before your point of interest, this will serve as inducement, because as price moves away, what's going to happen? People who wanted to enter in here or at the order block down here are going to start thinking that price is moving away from them, and they miss their entries. So what do? They start FOMOing in here, and they place their stops just below here, right? And as that happens, price then comes back and takes the liquidity into the original position that you would have entered into, right? Taking you out here, and then it moves away. Now, two things can happen here, right? We would have either entered on this candle here as an aggressive entry. We would have waited for the sweep of liquidity coming into the FVG, which was here. Alternatively, we could have waited for a new fair value gap to have formed here and taken an entry there. You agree? So a new fair value gap forms here, and as soon as we get a close above, so this candle here confirmed the order block. This candle closed above the fair value gap, so the very next candle, your entry would have been this candle here, and then you would have caught the entire move up here. The alternate to that is you could have waited for an optimal trade entry if you missed out. So from the let's take it here, from the low to the high here of this swing, you can see that price came into an order block, fair value gap, in or around the discount area, right? So this would be the fair value gap to use there. And you can see how whenever you look at fair value gaps or think about using a fair value gap, especially in this case a bullish fair value gap, what you want to see is price respecting the fair value gap in terms of candle body closes. And I mentioned this the other day to you. You don't want to see price closing below the fair value gaps, especially if you're bullish in this case. The only exception that we would give is price closing below, but the very next candle should move back in and close back above. So once you start to see PA like this form, then it sort of gives you some confidence that your conditions are right. You entered in an order block and a fair value gap, so you could have taken either or here, right? Order block or fair value gap in this particular one, and then price moved away. Now say you missed that again, right? What's your next port of call or call of action? You'd take a fib retracement either from here to the top here. I'm going to tell you why this is all black in a second, right? And then you've got price. Let's just hide this or lighten this for now, and then we'll talk about why I blacked it out in a second, right? We'll lighten it up there. Right, and then you've got price coming back into the discount area, into some sort of imbalance created here, and then shift away. Now all of this bear in mind is, look, give me 1 second, let me get to a higher time frame. With all of this and the low that we put in here, remember the low that we put in here took sell side liquidity here and here. Now the next draw on liquidity would be anything to the left and higher up. So what that would mean is we are looking for, or we're looking for, price to take here, 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 and ultimately here, right? This is more or less where we're going. Now we may not necessarily get this move up here, but I think we got a pretty decent chunk of it from the bottom to the top here. Now ICT has something called a graded swing, which basically means he separates the draw on liquidity. So if the draw is up here, if we take from the bottom of the range to the top, where you expect the draw on liquidity to be, and I'm just going to use a graded swing for this. Let's turn it the other way around. We want to see the, right, so equal quadrants in 25%. Right. Now you have the bottom here, which is 0. You have your 25% level here. There's your equilibrium here. There's a 75% level. And then finally, the draw on liquidity at 100% up there. At the 25% level is, so this is forecasting now, right? Say we didn't know we were at somewhere here and none of this was available to us. Using the graded swing, we could anticipate our entry to form around the 25%, which you see here. You could expect some sort of consolidation, but usually what we look for around the 50% is some sort of speed, right? So you see speed coming into the 50% and then speed going out there. So these left fair value gaps above and below. And then at the 75%, we want to see some sort of consolidation. So at the 50% and 75%, you're going to see consolidations happen and probably run sell stops within internal range here. Now, there's a chance that the 75% may be all that we get, which is coming up. We can come up into the 75%. Around the 50%, we may see that round of the sell stop. So if we start to fail here at the zoom candle, seeing as we took liquidity here the other day, price broke down here below this, creating a market structure shift, which created a dealing range for us. And at the time I told you, look for price to come to the 50% or above, and then you can take a short, and that was actually this short here, down here, right? Subsequent to that, the other day, what we got was price moved back above. So it took sell side and then it took buy side, which means whatever was created from here to here, sorry, from let's go back, whatever was created from here to here became a dealing range. Now, if you would have wanted to enter into BTC targeting maybe higher or liquidity just above here, you'd look for 50% level again. So from there, let's call it to down there. Anything above this 50%, below the 50% level would be your entry to take, and then we're going to go down into a low time frame and see what happened in here and what the possibilities are for a move higher. Now with the zoom model here, I'm actually looking for, if price respects the zoom candle here, which was basically the candle body of the highest closing up candle here before this happened. So this was accumulation, this was failure swing, and this was the opposing liquidity run. We have a push down here, and then this is now becoming the retrace. So my expectations is I want to see price run down into here, run stops internally here, fill in a fair value gap or the remainder of the fair value gap, come into this order block here, and then we'd look for a reversal pattern here to carry on higher to our target. So that's what I do expect. Where am I wrong on any short positions would be once price starts to consolidate. You can see the zoom candle here, which again is the body of the highest closing up candle. We're wrong above consolidation here. Once we start to see that, then you can be sure that this is on the menu and price will start to move for that 75% graded level that we have here, and then finally the 100% drawn liquidity to the left. So right now I'm looking for breakdown on a lower time frame here. So we have a failure swing up here and then an opposing liquidity run. I want to see if price can push here and then give us a continuation down here. Now what I'm not seeing here on this 5-minute time frame is any valid FEGs that I could use. I could probably use this one here, and let's see how that may work out in terms of price respecting the fair value gaps. And you can see it's not so, in fact it's up here. That would be the fair value gap. Now we did have some price closing above and then back below, so I'm not too happy in this particular price action here. So I'd want to see something more happen in this range, maybe, just maybe, one more push up here, then a reversal down, and we'll look for targeting the lows and anything in here with this fair value gap. And I'm going to show you why I blacked this candle out here in a second. Now in terms of entries down here, again you've got the zoom model giving you the entries. Let's go on a 15 minutes so this doesn't look too squashed up. We had the low put in here, we had the opposing liquidity run, a push, and this was the retrace, right? The retrace came to where? It came into the lowest closing down candle before the break of structure. Can you see that? This is the real low in the market, and whatever happened here with the NFP was the manipulation run or the opposing liquidity run here. So as price came back in here, this was an entry for us with a stop below here. If you missed that, then you're going to look lower time frame within here around your entry for something to enter in here, and which we didn't really get anything on a 15-minute. Let's check a 5-minute. Nothing too let's have a look here, right? You have a very tiny fair value gap here, not a fan of, but could be used to confirm market structure shift and fair and order block confirmation. But you also have this here, which is the lowest closing down candle, and this is where your entries are going to form. So the lowest closing down candle before the opposing liquidity run is where entries are going to form. And if we had dragged that out in time here, here, you can see there, right? Does that make sense? Your entries form at the lowest closing down candle before the liquidity run. So if this was the lowest closing down candle and this was the liquidity run here, if you take the opening of your lowest closing down candle across in time, this is where your entries are going to form. So that's what happened there. Just give me a second. And if we draw the fair value gap here, let's just get this as tight as possible. This was the fair value gap that we used to confirm a shift in market structure low time frame. If we draw that one out in time, you could see the price tapped into that there, right? So, and filled in a further imbalance here. Now there's four things there's four things to take note of here, right? This didn't completely fill the imbalance there, but we also had the imbalance in here, right? So not a complete fill, but that's fine. That gave you an entry to take the move higher, stops below the candlestick lows here. Any questions on TikTok? Right, so now we are here. We had a shift in structure here. Price failed to go higher with a failure swing, which makes this a breaker block here, or sorry, a mitigation block. I think we could use this as a mitigation block. We could use that as a mitigation block, and then we have our fair value gap lying inside here. So we are looking for price to, if we were aggressive, it would be fib retracement, anything above the 50%, 50% and above, we'd be looking to short that down, right? So if we are here now, we're going to get some sort of order pairing going on. We already had internal range liquidity run here, a shift here, retracement here. Now we're looking for continuation down to here and here, right? These are all liquidity points down there. And again, I said we are wrong above the zoom candle and any consolidation above this area here. Now, there is a theory that I've been using, and it's mainly used on indices and forex. I'm going to talk about it now. I can't go into too much detail because this is not my work. Confirmation of the fib retracement at 50 would be an order block. No. Right, so before we get into that, there's 4 things to consider, right? When you get, so there's 4 things, right? There's expansion, there's consolidation, there's reversals, and there's retracement. Those are the 4 tenets. Consolidation, expansion, reversal, retracement. Retracements will seek imbalance. So anything retracing will seek imbalance before moving. Expansion will seek an order block. So anything expanding out of a range, whether you're using market maker, buy models or whatever, anything expanding out of a range would seek order block. So expansion seeks order block. Retracement seeks imbalance. Consolidation will look for a mean reversion or 50%. So if this was a consolidation here and this was the range, if price comes out, it will look to come back into 50% or equilibrium of the range before continuation, right? So that's consolidation. So whether you get it in terms of something like this, where you have price consolidating, price moves down here, let's call it, price moves down here. You often see something like this, but don't count on it, right? Price will come back into the consolidation and then continue. Other times, if you're using a market maker sell model in this case, you won't get something like that because these models don't let's just get rid of all this. These models will look to consolidate, use up internal range liquidity. So let's just make this green. Let's make these red. Let's do another one down here and another one down here. And then we have these up here, and finally up here. So you would move from here, I don't know why I turned that on, here to here. Now within here, you're going to get 2 things happen within here, right? You're going to get price wanting to take internal range liquidity, which means it can do something like this, run the internal range stops, and then continue down. Which time frame is fib retracement applicable? All time frames, brother, all time frames. price is fractal. You can use, or every time frame looks like every other time frame, right? So you're going to want to see price run either internal range liquidity, which is something in here. So you may have a fair value gap up here, or something internal like here. Price will go there and then continue. When we get here, same story until we get down here, right? This is the goal post, right? That's the goal post. Once we get in here, you want to look for a smart money reversal, and that would come as either a failure swing and a move up, or accumulation, failure swing, opposing liquidity run, push, retrace, which gives us the model, and then continuation. Now once you start to move from a sell side of the curve to buy side of the curve, you're going to do the opposite of what happened here, and the draw on liquidity is going to be each point here. In this particular case, we would look at this here, which is the origin of the move, as the draw on liquidity, or the goalpost, the end game. And the same story here. You would have retracement, internal range liquidity swept, continuation, same story here. Finally you get here and then up here, right? So that's how price, let me just get rid of all this, close that up. This is how price moves. Let me get rid of all of this right now. Right. So that's the market maker buy model and sell model explained shorthand. Now, when we look at cryptos, people don't consider that these follow traditional markets. And if it is following traditional markets, then we need to use some traditional market tricks. And one of them is using the extended range, extended trading hours, which is 8 p.m. to 4 a.m. Sorry, 4 p.m. to 4 a.m. Scratch that out, 4 p.m. to 4 a.m. And anything that happens there is considered to be non-existent, right, or a void. And what we would then do there, and I'm going to show you a better example, is, so this is from 4 p.m. on this particular day, and this is 4 a.m. here. We'd mark off the opening prices of these candles here, and here, which is already marked here. And if the closing of the session is higher than the opening of the session, price will tend to be drawn to each other like a magnet, right? So here we expect this to fill whatever happened in here. Now I'm going to show you an example from last week on something else. US 30, right? And we were, let's look at here, right? 5 minute. Right, now I think I have an indicator for this already. Let me see if it works. Here we go. Right. So the area in here is 4 p.m. to 4 a.m. This is the, let's have a look up here. Sorry, here. This is the area in here. This is the opening of the range, and this was the closing here, right? Now, had I blanked out everything as if nothing happened between 4 p.m. to 4 a.m., let's just see what happens there. So that gives us this candle here to 4 a.m. somewhere here. Anything that happened within there is there, and let's blank that out now, right? That never existed. So after the opening here, price is going to look back to a position before the market closed at 4 p.m. So it's going to look back into this range here and see if there's any points of interest or order blocks that it can go to. Since it opened a bit lower here, we expect price to be drawn back into the 4 p.m. opening. And if we go back in time, you can see we do have an order block here. Let's just do this, right? So everything in the black, non-existent. Horizontal ray here. We have an order block here. This is the opening of the order block. Let's make it red. Let's make it bigger. Right, so we have all this price range. We have this entire order block here. We could have even used the bottom here, sorry. Let's use the bottom there. Let's take this and put them down there. Right. And then we have the 4 p.m. opening price itself, and then we had a small fair value gap here, which was full, right? Let's go and see what price did on the left-hand side. Can you see that? So as price opened, it went into the 4 p.m. price, which looked back here. No, this is all New York time, 4 p.m. to 4 a.m. New York time. Everything I talk about is all based on New York time. It's not South African time or any other time. So this was the protractionary period here. Price drew in to this point here, and that's all that you needed to do to take a short, right? You just needed to know where price was, or where the drawn liquidity was. In this case, it was into this range here. You can see how price respected this here, and then price moved away. If you were looking for an entry in this particular model, if you didn't catch the entry here or any low time frame FEG market structure shifts here, all you would have done is taken a fib retracement from the top of the range here to the bottom. For the Elliott wave, guys, 1, 2, 3, 4, 5 wave move down, 3 wave move up. You'd look at the 70.5% or the order block here. That's your short. Stop above here, and NFP came about, and that's what happened. Right, does that make sense? So that's using the extended hours, 4 p.m. to 4 a.m. as a void, and price will tend to draw back or look back into the void to a place before the close of the market and then reverse. So having said that, if we go back to BTC and do the same thing, you'd see that in here we had price closing and being drawn to, I think it was around here. I mean, we can look at it. 4 p.m. is here. 4 a.m. Sorry, 4 a.m. is here. Right, the principles are the same. Now this is all obviously untested in crypto. Nobody's using this in crypto at all. And 4 p.m. was here. So anything below there, anything above there. Right. So if we treated anything in here as if it didn't exist, the trick is that price will look back to where it closed, which was here. Right, watch this now. I think we can get a fair value gap in here just before the price closed. Let's look at this. There's one right here. Right, that's a fair value gap in there. And I'm only interested in this candle here, right? I'm zooming in. Anything in the black is non-existent to me, doesn't exist, I don't care for. Right, so that's a fair value gap there. Even if you didn't use it as a fair value gap, you have all of this as an order block in here. Right? All of this is an order block. When price came back, you can see how it tapped into the order block and then shot up here. Now, although you're referencing the void as non-existent trading or any time anything going on in here, it still remembers that there is some price action in here. So what does it do? It takes the liquidity above here, then reverses. So just keep that in mind when you are trading. Now, having said that and talking about the void, this is one of the reasons why if we were to have any targets here on Bitcoin and we were to break down, I want to see the rest of this particular void filled out as price draws back into here. And there is a small chance that on a slightly higher time frame, that if we were looking at things in terms of, let's look here. If we were looking at accumulation, failure swing, opposing liquidity run, push, then this would be the retrace we're looking for, and then that would be the continuation. So if we start to break down here, this would be the first port of call, taking all the liquidity generated here. There's liquidity underneath here, and this would be our pause at the start of the move. So we had some sort of buy model here, buy side of the curve, and now we move into sell side of the curve and we carry on. So one of the reasons why I want to see price come in here, fill up the void, and also take the liquidity resting here, and a little below here, which was sort of an inducement to this level here, right? So that's Bitcoin, and that's the theories using the void, using the zoom model, and what we want to see happen. Any questions? Anything in particular you guys want to talk about? What's the name of the indicator that it's a private indicator from another group. How can I get my KD higher? Bear, for you there's no hope. Can we look at the time zones for the London hour? Okay, sure. Let's look at US 30, NAS, whatever it is. You want to look at the time zones. So all I do is I have the ICT market sessions indicator on here. Everything is on here. I'm going to go through the time zones now that I use. London, 2 to 7. Anything after 5 to 7 is extended, or London lunch, extended trading hours, so 2 to 7 here. We have 9:30 to 1600 on New York. 8 to 2 as the Asia session. 2 to 5 as the London kill zone. So most of your entries will most likely occur in the London kill zone. And the New York kill zone will be 8 to 9:30. Right, you can also put the void in here if you want. Al dente, if you're listening, you can put the void in here, 16 to 14, and then it will show it up here. Now, let's have a look here. You have all the sessions marked off. Right? You have all the sessions marked off. Every morning, what you're going to do is midnight, you're going to mark off New York. Let's have a look here. Midnight New York, which is here, opening of midnight New York. So you mark that off. Now, what's going to happen here is London is going to have a protractionary period, which is almost the fake move before the real move, between 2 to 5. So if these were Asia highs and lows, between 2 to 5, you're going to see London sweep those lows, give you a entry model here like that, and then in New York you're going to see the highs being taken. Now New York here was just a continuation of what London did in this particular day. So you're interested in the Asian range. London would usually take the Asia high and then the low. So if London took the Asia high and then the Asia low, New York would take the London high and then the London lows, right? There's many instances you can see that forming. There's a specific time window that you need to use. Let's have a look here, right? When taking these trades. Right, so in this particular day, Asia range here, London took the Asia range high and then went for the lows. New York retraced into London, taking the liquidity here, and then continuation down. Now, there's a specific, let's just switch this off here, but there's specific times in the day that you want to be trading. And if you know the times in the day or what you expect, then I know around which time of the day or which time in the day, let's just switch this off, I'm expecting prices to change the state of delivery, which is moving from buy side program to sell side program. Here at 9:12, I expect the program to change from buy side to sell side, so I'd be looking for shorts here. At 12:12, I'm expecting a change in the state of delivery, so it moves from sell side to buy side. At 15:12, I'm expecting a change in the state of delivery of price from buy to sell. At 9:12, expecting a change in the state of delivery from sell to buy. Right, so these are all algorithmically programmed, specific times in the day. So if you have a trade to take and you coordinated it with the specific time in the day, I know that at 9:12 I'm expecting a change in the state of delivery. So I could sell here once price broke down, or once price retraced here, I can sell here because I'm expecting the change in the state of delivery from buy side to sell side. Now if you took it a bit further, because these are 3-hour macros, if you took it a bit further and you marked off from, let's switch this off here. If you mark off from 8 a.m. to 11 a.m. and if you took a FIB time zone of that here to here, you can see that your 9:12 period falls here. That's where you're expecting reversals to happen. And if I took a fib from the 9:12 to the 11, 9:12, just go one lower, 9:12 to 11, I know I expect reversals to happen at the 0.4, which is here, and that's what happened. This is going to happen every day, all day, every day. Every 3 hours, you're going to get a specific change in the state of delivery. On Wednesdays in particular, you're going to get a change in the state of delivery between 4 a.m. and 8 a.m. You're going to see price take liquidity and run. Every day between 8 and 8:15, you are going to see price take liquidity and run every day. Let's just have a look at this one before time closed. Let's look here. For to 8:15 is here. Well, this was NFP, so that happened. Let's look at another day. Four to 8:15. Here you go. Right, this was 8:15 up, all the way up here. Right, so this is going to offer you an entry here exactly after 8:15. You're going to see a run of liquidity and a push higher. Your stop is never going to be more than 20. Let's look at NAS because it's going to work out a bit better on NAS, right? So every day between there's several things you can do in a day. Let's look at 4 to 8. What time frame is this? Right. 4 a.m. to 8:15. There. Here you go. Let's zoom into that. Come 8:15, price is going to run for the nearest liquidity. And it's going to run in the opposite direction. Your stop or your entry on this is always going to be a 20-point stop. So if you enter there, your stop is going to be 20 and your target is going to always be $50 every day. There. In this particular case, if you got, obviously you got more, but it's not almost not always going to be the same. This is New York time, all New York time, no South African time, no other time. Right, so done with the tips and tricks here. Let's look at US 30 itself. In fact, we'll come back to US 30. Let me just tackle a few other things. Ethereum, same story. We're looking for the draw higher. We have imbalance below us. Not completely filled. There is liquidity resting. Well, I'd like to say there's liquidity resting below here, but I don't think there is, since this move down here took the liquidity resting here. So technically there's nothing below here. So if what price were to come into this area, it's actually going to go lower to somewhere here or in here, right? So just keep that in mind. If liquidity has been taken, that means there's nothing resting below. That if price comes here, it's going to actually head down to seek liquidity elsewhere before retracing. So again, accumulation, failure, swing, opposite, liquidity run, continuation, push, retrace, continuation. Now the entries on Ethereum, like I said before, are going to form around the lowest closing down candle before the liquidity run. Let's just go to a 1 hour. The lowest closing down candle here is this little small tiny candle here. Right, so that's the opening price of that candle. Let's magnet tool that one. And as price comes back into that level here, these are where your entries are going to form. And we have two different zoom models here, right? We have the higher one here, and we have a lower one that it formed here, right? With this being the lowest closing down candle, so we have a confluence of price here that if Ethereum had to retrace here, we could look for reversals in price. Having said that, if we are looking for retracement because our expectancy is higher and or more bullish, then retracement seek out imbalance, and then we can see there's some imbalance in here. And there may be a tiny one in here from the looks of it. We can check that out. But this is the sort of move that we're looking for. Right, so that's Ethereum. Play these accordingly. If the retracement comes, we'd be looking for buys, just like we are looking for buys on BTC to a similar place structurally. We look for the same on Ethereum. My Discord guys, what are y'all looking for me to look at?
So, quick question. I don't know if anybody on the call knows about this, but so the FTX collapse
Yes.
was approximately a month ago.
Yes.
And I've heard people talking about after 30 days, redemptions will open. So I don't know if that means people can get funds out of maybe the U.S. exchange, or I don't know if any of the other.
Is the U.S. exchange linked to? I was under the impression that it's a separate entity and doesn't affect anything else.
Right, but I think because of the bankruptcy proceedings, everything was locked down, right?
Yep.
So I think after 30 days, which we're coming up on apparently this week, redemptions will open, which means there might be there could be some potential for people to flood the market and sell, or I don't know what's going to happen.
Yeah,
but
it's possible because I think there's
Guaranteed.
FOMC coming up. When's the 14th? 10 days. So probably next week, not the coming week, the following week. We could see something happen around there that would frame something. Now, structurally on the entire, like if I just look at Bitcoin as a whole here, there were comparisons to this piece of price action here, where this was the low and this was the little consolidation below before we fell, to this being that consolidation, this the low, and this the little consolidation underneath it, and that being the expectancy. And I don't mind it either way. All I'm interested in is, because to be honest, there's only one bit of the only thing I don't like about BTC at the moment is these, while this was made a slight lower low here on the 21st of November, these are sort of relative equal lows here, right? And generally what happens here is if you get some sort of sideways movement, this is going to get run. Now, this could happen from where we are right now, or in the next week we retrace, like I said here, we push for the liquidity resting above here, and then we head down here, we do the run here, because all of our moves or our models, and you would remember me saying it last time, reversals don't happen from consolidations. So we can't expect price to reverse from a consolidation. If this is a consolidation that we are in, price doesn't magically just start shooting up. If this was a consolidation, price would do that, then it would come back to equilibrium and then move away, right? So this would be the move that we would look for. Or price would seek liquidity, either top side, then lower, then higher, right? So it needs to get liquidity somewhere. If it wants to go higher, then it needs to drop the liquidity or sweep the liquidity that's resting below. This would give us a model to trade, because this consolidation would help us across in time to do that. So right now I'm not a fan of what's going on here. We'll play this sort of lower time frame, but at the back of our head, depending on what equities may do, we're not overtly bullish or bearish, right? This on the daily has broken structure here. Once it went through this level here, you saw me, this is the fair value gap here. Price traded through the order block here. Price closed above here. So this is now a shift in market structure. So the safer option would be for us to consider, we would look for shorts. I mean, you could look for shorts here. We would look for longs. Let me just undo that. We would look for longs on a fib retracement there. Now, you'd also saw me say that once you get a move like that, this middle leg is a dangerous leg, because this middle leg acts or holds a lot of liquidity below it. So when you FOMO and you enter here because you saw a break of structure here, then you put your stop losses here, this is going to happen. And that sort of feeds into the model that we were just saying here. If we can get that and hold, then there's a chance that we may go back up here and pair orders in the breaker block here, or you could call this a mitigation block, because this happened so fast that people here are trapped now. So as price gets back into here and starts to pair orders, because this only offered sell side liquidity, once we come in here and offer some buy side, so the people who longed here now are looking to sell their positions to people who longed here are looking to sell their longs, and they'll sell to this, right? So I want price to come in here to pair orders and then look for that. I don't know if we get it, but we'll take it a step at a time and see what gives. If we get the retracement that we want at the place that we want, and more importantly at the time that we want it, then yeah, why not? We'll take something up, because some of the altcoins are looking bullish, right? If you look at most of them, they look like they want to do something. Give me any pair you guys are interested in. What have you been looking at? CRV?
Yeah, let's do CRV. Think Frenchie wanted to look at CRV too. So.
Yeah. So again, if you look at the model here, same model, right? Failure swing, opposing liquidity run, and now we're looking for something like that. That's what we're looking for. Now, let's look here. Huge fair value gap in here. Let's go low time frame here. We could have, this is an ugly one, right, on the daily. Let's just switch down a few notches. It's still ugly here on this time frame as well. But we have a fair value gap in here. And like I said, if we expect BTC to do the retracement that we wanted it to, then we'd look for price to come back into here at least. Right, so maybe an A, there's your B here, and a C wave. Or you could call this accumulation, failure swing, opposing liquidity run, push, retrace, continuation, right? So I'd look for price to come back below the 50% of this move up. You can't ignore a candle like this, right, from the lows here. It's pretty
Yeah, and that's the one that has the huge, like,
Yeah,
record-setting volume for
yeah.
CRV
So if we put
too. So
so if we put volume in here, it probably has the most volume ever, right? Yeah, yeah. Highest buying volume. This had the high. Now you see this is interesting because this candle had the highest sell volume, right? And the very next one had the highest buy volume. But price refused to go lower on a candle like this. That's a bit telling. The
right.
highest,
So I mean, I always find the looking at the candle, the volume, right? So if you look at the down candle, mostly wick,
yes, mostly wick.
right? So even though the volume candle is red and the candle itself closed red, my guess is going to be that that's mostly buy volume, even though it closed red, right?
Yeah.
My guess is there's a heavy set of volume of buy orders sitting there, and they were sold into. Um, so it's deceiving to look at just the color of the candle. If you look at the shape of the candle, I think that gives you more information as far as there's a ton of demand right there, right? So
So
chances of us going lower than that
yeah,
point before we go much higher, I think is really, really low.
yeah. So if you look at the weekly, this is massive compared to anything
Right.
we've seen. January 2021 was the last one was here. Now let's look at why did it come there in particularly? Why didn't it stop lower or go lower? And usually what happens with these candles, so we've got the low marked in here, right? And that you can see the flags here. That was our target. That has been our target. But if we were somehow front run for some reason, I actually should have targeted here. Not this down candle and sort of order block here, but the one next to it. This one, right? And I'll tell you why I should have targeted that particular candle and not the one next to it or the lows. Because if you look at this particular candle, the one next to it, on a lower time frame, what that white candle is going to look like is it's going to be a failure swing candle, which means that candle on a lower time frame that made a lower high here compared to here is going to look like this. So if this was the down, it's going to look something like that, right? A failure swing candle. If you go on a lower time frame, so failure swing candles, this candle here that led to a move up here goes back to the model that I just showed you. These house liquidity, right? Not even the candle before it, it's the stops that are underneath this candle. So your target would be there. Now, if you look at this candle, it's why you don't always target the absolute highs in the range. You target the ones next to it. So if I had to go for a target in this range, I wouldn't target the absolute highs. I would actually go there, right? Same story. I'd actually go, if we were targeting anything down here, we'd go for the wiki ones, not the absolute highs, because the ones that are at the highs are very too much wick, and mostly those are the manipulated stop run candles. The ones that fall next to it are the real candles, inverted commas, and this is where the liquidity would have lied. So let's just go down to a 6 hour, see what actually went down there. Right, can you see that? This low is a failure swing. Can you see, like I showed it to you just now, price moved up, failure swing, failed to go lower, and then carried on upward. So what happened here? All stops are resting below here now, right? There's liquidity lying below here. So this is why when price came down, you didn't have to target the low here or down here. You just had to target that failure swing there. That would have been enough. It could have sometimes even stopped exactly there and moved away. So that's just something to keep in mind when targeting liquidity. You want to look for the failure swing candles and not often the low candles, right? The lowest candles. Right, so even if we didn't know our little market structure shift trick, we would consider this to be a break in structure here, right? Say we didn't know our little trick down here. This is a break in structure or shift in structure. Now we're looking for some sort of retrace and then continuation. That's what we're looking for. We're looking for a reversal. Now remember I mentioned earlier, reversals look for liquidity pools. Retracements look for imbalances. Expansions look for order blocks, and consolidations look for equilibrium or 50%. So if this was a reversal here, the liquidity pool it found was underneath here, stops here. So we could consider this to be a reversal, and our job here now is, where does this go to? We look to enter in here some sort of reversal model here, and where's the draw on liquidity now? The draw on liquidity is everything to the left is on the menu, here, here, and here. Coincides with the fair value gap in here, and we have all that breaker block shit happening in there. But safely I would look to target anything like I said, here, here, and here. Pretty decent move. It's almost double, right? More than double, almost triple.
Yeah, 3x. If we
Yeah.
can get in around 53, 54, it's
Yeah.
you're looking at a 3x from here. So.
That's what we need to do. Then you start to see shit like that happening. And then we're not fans of this kind of shit, because it has a tendency to do that, right? And then overall we could look at a bigger buy, because if we get that, yeah, then we ran the lows from a consolidation, then we'd start to look for that to happen if it wants to. But for now my eyes on a 3x, a decent 3x if we get it. Yeah, sure, why not? That's where the draw on liquidity has shifted from sell side to buy side, and all of this is on the menu. If we had to grade it, like I mentioned at the beginning of the stream, then let's just look at this now. So we take a fib retracement from the top to the bottom. Here, there, and use a grading fib. Lo and behold, if you listen to what I told you at the beginning of the stream, your entry is going to form around the 25%. See that? That sort of aligns up. So now we got extra confluence there, which is also below the 50% in a fair value gap. So we've got some confluence going around for us around that 56 to 54 kind of mark. If we had to look to the left, we can almost maybe get more of an exact figure using this down candle here, lowest closing down candle. This is an up candle. Lowest closing down candle is here, and we'd use the top of that, 58. So anything from there down would start to form your entry. Then expectations. We are going to probably get speed. So once we do this and reverse, you are going to get speed coming through here, right? So speed through here, you may get a pause in here, and then speed through here again into the 75%. Here you may get runs of stops internally, and then finally the draw on liquidity here into this fair value gap. So in the middle is always, the middle legs is going to be about speed. Let me show you what I'm talking about. Here's gold, right? Now, you know, and we've been targeting this, right? This is going to be on the menu. This is coming. But when is it coming? That's the question. So if this was the low, and this here 1807 is the draw on the liquidity, this here, because we moved from sell side to buy side, or market maker sell model to market maker buy model. Then the draw on liquidity from entries down here, leaving all these relative equal lows, was going to be this, 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 and finally this, right? You agree? Now,
Yep.
watch this. This is actually has to be turned the other way around. Need to redo these flips. Remember what I said about speed just now, right? Your entries form around the 25%. Here you go. See that? Just this little, so on your chart, what happens is if you're bullish, see just this little move here. So if this was Monday, for example, Tuesday would retrace a bit into Monday and then carry on, right? So if you're bullish, that's what happens. You get a slight retracement and then continuation, slight retracement and then continuation. So that's what actually happened around here. Now at the 25% is where you got your entry formed, right? Which was the top of this order block, if I'm not mistaken. Let's have a look at that. This is a daily chart. And if you had to enter on a daily, there, that's the tap, right? Just that. Right, so besides that, that is where your entry formed. Now watch the next model. Now say we didn't know anything happening here. And we can easily do that with this, right? We knew the entry forming around the 25% was going to happen here. Our expectation is as it approaches the 50%, you're going to get a pause, but there's going to be speed coming into the 50%, a pause and speed going out. So we know there's going to be speed coming in, a pause, could be sideways, and then speed going out, because the algos usually leave a gap above and below. And this may have come at some point, or it may come to take the imbalance and then continue if it's running stops internally and then continuation, or it leaves them for later on. Later on in life is where we're going to come and start eating all of these up once we've hit our objective all the way up here, right? Once we've hit our objective all the way up here, as we come down, everything's going to be rebalanced again, right? So having said that, at the 50% is where you're going to see some speed. At the 75% is where we're going to get some sort of consolidation and possible internal stops before continuation. So let's just go away from here now and look at what happened there. Right, can you see that? You had speed coming in, you had the pause, and then you had speed going out. All around the 50%. At the 75%, what did we get? We had some sort of consolidation, retracement, shallow stops being run on the lower time frames, and then price moved away. So if we go down to 15-minute, around the 75%, you see all of this happening here now. Right, so this was the speed bit of it here and here. And this was running the stops, looking for liquidity here, all of that nonsense, right? And then upward. So the expectation is still up on gold until we get to the objective or terminus, which is the draw on liquidity that's going to be here, right? Which is also an inducement level in terms of this was the last high before the break of the low. There is liquidity resting above here. There is no short entry until inducement liquidity has been taken. So as inducement liquidity is taken, then we can do that. So gold's almost ready. Soon. Right. So where were we? Same story here. Back to this. Expect the speed through the 50% pause speed. Expect this to do the funny business, and then expect the terminus or target to be hit there. Make sense? Simple grading, but the grading only helps if you know where the draw on liquidity is. So if we know the draw on liquidity is complete here to the downside, and then the next draw is up here, and we're assuming up here on a high time frame, then we'd look for all of these moves to move up there. But at the 25%,
So gold.
I can't hear you, breaking up. You're breaking up, Sloth.
Sorry, the dog's going crazy,
No
so I was
problem.
trying to keep it on mute. So back on gold, if we're looking for a swing down to take those equal loads,
Yeah.
as far as market shift goes, we'd have to come down past the breaker, right? I mean, if we're looking at a higher time frame.
On a higher time frame,
So-
yeah. But what you're gonna start seeing here is, once we see displacement big enough, like you saw here on this end here, so things have to start slowing down first for us to do that, right? So
Yeah.
you're
So
gonna-
the thing is, there was no real 50%. We didn't get an optimal entry, at least on the higher time frame, right?
yeah, no, there's nothing.
So you've got to
yeah.
be a bit more aggressive once you see displacement. If you're going to do a swing, just
Yeah, so you're
take your
gonna
entry.
you're gonna want to see smaller candles form at the level. So those smaller candles are now going to become your order blocks to the upside, right? So a series of candles forming like that. Some sort of fair value gap in the middle here. Let's just make that there. Right, so those are all your, these would be green candles. Right, now we're talking a low time frame, not a daily time frame, right? And then we'd want to see, obviously, the liquidity being taken here somewhere. The liquidity we're talking about being taken here. Wicks above, and then the next candles here, we want to see something like that being done on a red candle. Once we see that, we have either the option to retrace back in here like that, to form our entry at a 50% or optimal trade entry, and then the next candles you want to see is down there. But as the FVG forms, obviously we don't want to see these red candles start to close above the FVG, right? So I should actually do something like that. They can wick above, but they shouldn't close above. Yeah, so that's where we want to enter. We're going to enter at an optimal trade entry, or we're going to build a position around, framed around the fair value gap that forms here. Once this is done, and this confirms, this is where we are going to play. There. Then you're going to start to see the opposite happen, right? So if we know the drawn liquidity is to the downside from wherever this ends up, we know on a high time frame our entry is going to form around here somewhere, 25%. So even if you miss the absolute top, you're going to get a situation where something like that may happen. A spike in, and then continuation. Makes sense. We may never get a top, but if we plan it time-wise, and I'll tell you in the group more or less how it's going to be based on a few things, right? And obviously the rest of you guys that are not part of the group will not be privy to this, but if we plan this enough or good enough, let's go here. At the time and the day that that's going to happen, using our models, we are going to be able to, almost to the minute of the day, right? We'll be able to tell you when the change in the state of delivery moves. Let's look at here. See this level in time here? This particular one was 612, right? We'll be able to form our trade on our expectancy, and the reversal, the change in the state of delivery will happen around one of these times, and we will move from the market going up into the level down. And we'll be able to use one of these times like this to frame the change in the state of delivery from upside to downside. And that I'll actively monitor in the group because we have the magic time, right? We'll know the time. We'll know the time and we'll know the day. Most likely it will be a Wednesday. Probably going to be a Wednesday. Right, so your your plan for gold should then be, if you want to scalp, would then be any retracements coming back into the origin here should be bought in expectancy to do that, because that's almost a $20 move in itself. Again, all the stuff here, liquidity runs, you may get something like that and then that. So let's see which comes first. If we get a retracement, that's what we're going to look for. And we could have, let's have a look here. We could have actually taken a trade on gold in terms of a long based on the change in the state of delivery. So we had here fair value gap. Let's look at the next one. And we had here, right? Let's do that a bit better. Can you see how this formed around the red level here? That's an entry we could have taken at the bottom. It's always time and then price. We're not interested in price unless it's at a specific time. So once we have price and time together, that's the entry, that's the trade. So whenever this forms, we'll take it. Let's wait for FOMC and all the other bits to happen. Yeah, what else? Oil, well, you know the story on oil. This was the expectancy of the move. Anticipate entries to form in the gray. Same Zoom model story. And we actually took I think you stepped out of the short and go on oil, right? Over the weekend.
Yeah, I stepped out on, yeah, because I didn't want to, you know how it is, right? The move down will probably happen in the middle of the night when I can't trade.
Yeah.
Stupid Merc, and then it's gonna blast off without me. So I didn't want to get effed holding a short one.
For all of those that are not or weren't aware, this was the short on oil. This was the fair value gap. This was the confirmation of the, there's even a tiny fair value gap here, but it's balanced, right? Once this wick went into here, that could have been an entry on a low time frame, but our expectancy, because of this tiny wick that happened in here, this balanced out the price range in here, so we shouldn't expect price to then come back up here. Now, if you are aware of things like that, then you should be aware that, or it should be make you more aware that if price already balanced any imbalances in here and it shouldn't get back up here, then any positions you take in here, your stop can actually be here or here, and it doesn't have to be up here. So that's a small little trick there. This balanced the range and the imbalance here. Your stops can be here. This was the entry here. Can you see all this? How the price respects the fair value gap but not closing above it. Any closes above it, we cut the trade before it wicks us out. This is what we want to see, respecting the fair value gap, because as this confirmed the order block here, this confirmed the shift in structure. What you needed to do, take a fib, look for the 50%, look at the fair value gap. This actually hit the golden zone to the T, and that was your entry. Now retracements seek imbalance, so you're going to get something coming in here. You don't want to see it play above here. As it comes in here, you want to see breakdown here and then continuation, and we are looking for things to eat, which are here, 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 back into the fair value gap and the entry around here. This is where our entry is going to form. Right. Don't think there's much else to talk about. US 30, if we get a retracement back into this level, the gray zone here, that's something to take, because this was not reversal, this was retracement into imbalance. This is your zoom model playing out here. Any retracement back into the gray, it may go as low as this, then come back up here. This is the entry to take to get higher on US 30, because the draw on liquidity for US 30, and I haven't graded it yet, we can take a look quickly, because the draw on liquidity seems to be a bit higher. I think it may want to go here, right? Keep getting this wrong. Let's turn this the other way around. What the hell, man? There. Right, again, let's take a look at a few things. Entry forming around the 25%. That's a check. There's it here. That's all that it needed. Speed through the 50%. There's your speed here and here. There's your speed out. And consolidation around the 75%. Any stops being run internally. We can sort of see that happening here. Right, especially in this PA here, we were running stops here before this move up, and the target is actually here, right there. Let's put that. That seems to be what it wants to do. Right, so we almost at target here, almost there, which is basically the real high before all of this shit happened. We would consider this to be the real high, drawn out in time. It's a zoom candle. So basically what this level here is, if you turn it upside down, is this, right? All it is this level here. See the gray? That's what it is. It's just this here. So that's where we would expect something to happen in here.
So at that level, that's a low risk short,
Yeah.
right? I mean,
Yeah.
because It shouldn't blast. There's no way it's going to blast through that
Shouldn't.
level.
Shouldn't.
So the only thing, you take your short, if it starts to consolidate, you cut it, right?
Correct.
That's an easy play right there.
Yeah. So
So
we're looking for this high here. Not so much here. Just in here. Anything in here. On the menu would most likely be where I have the, yeah, I'd say this high here or in here. In the gray ideally. Also aligns with the broadening formation that's happening here. So I don't know what's going on here because looks like either an A, B, C expanded flat kind of situation. And we get that.
yeah, you remember your high time frame
Yeah.
months ago was
Yeah, across the
on
board
that
it
run
was almost the same thing, right? If you look at S&P 5.
4,200 was always the
Yeah.
target.
Let's look at S&P. And we'll end it on S&P. Yeah. So you can see with S&P, besides these trend lines holding us back here, I think the actual inducement level on the high time frame was the high that before the break of the low was here, right? 4200, 4170, 4200. So that's where the draw on liquidity should be or will be quick. We'll end it off on a graded swing for S&P here. So if this is the expectation of the draw on liquidity, entry at the 25%, there you go. That's your entry there. We had stops being run. Now remember I told you it's either speed or it's stops being run on both sides. So we had buy side, then sell side here, and then continuation. And you won't really see stops being run at the 75% if they were done at the 50%. So the 75% was actually consolidation and then speed here. So you're going to start to see something like that now. Just there is enough. And if we want to be a bit more accurate, what I would do is there anything to the left of us? We could most likely use this guy here. Just this order block here. Run across in time. Could use him as a guide. There, or zoom. There. Yeah. Now you should start to see some sort of SMT divergence in terms of US 30 being an expanded flat, but S&P being like a normal, like a regular kind of flat correction, right? So S&P doing that, going higher, and sorry, US 30 going higher, S&P making lower, so that's your SMT divergence there. And that is it. Any other questions before I leave?
Thank you, sir. Always awesome stuff.
Let's have a look here. Yeah. We'll try and time BTC, but most likely only tomorrow. I don't want to do anything tonight, especially on a weekend, because what happens is if we treat, I'm going to show you something before we leave, right? Because your second void is actually going to be the close on Friday. Friday's close is, where are we in time? Right, so Friday's close is 4:30. And the open on Monday is, Sunday night is 18:30 New York time. Uh, 18:30, come on. Let's just get that, zoom in here. And what we do with this that no one else is doing, 16:30 is there. Let's get 16:30 Friday. And 18:30 is the opening here. We treat this guy as a void. So as if nothing happened on the weekend, right? That means we have a price here at 16:30 and an opening price here, and you can see how so all of this should happen. You can see how price is drawn back to it here. Can you see that? And it acts as resistance until it breaks up. So we can use the weekends, Friday close to Sunday open, as a void in time, and use the open and the close as a look back to where price is likely to come back to before moving away, either there or there. Right, so that's your last gem to use, and this is only on crypto, by the way. So we've got two voids that we're looking to fill, and let's see what happens. What is the void for this week here? It's 16:30 to whatever happens in here. Imagine all of this didn't exist. Right? So whatever happens at the market open, and it looks like we are going to, let's just do this. This is 16:30. If we open higher, so now we can start to cook with fire, right? If we open higher, somewhere around where we are right now, there, it's going to be drawn here, but it's going to remember this high and this high in here, right? So what do you think is going to happen then? Most likely, once it opens, we're going to be drawn here, and then we're going to do that. Once we do that, we're going to do that. And once we do that, we're going to create a dealing range here. We took buy side, we took sell side. That's the entry on the retracement that we're going to look for. Right? Make sense? Let's see how it plays out.
Yeah, basically the reverse of last weekend. So
yeah, just the other way.
Let's see
what happens. Right. We'll DXY and Matic, please. Al Dente, I'll do that for you privately. Right, upload this to YouTube for the rest of you guys, and I shall catch you on Discord. TikTok, you guys are very quiet, so I would assume that there are no more questions, and there's nothing that you need explained. 10 seconds.
Thanks, boss.
No problem. Catch you later.